There's a phrase most Americans have never heard, yet it quietly shapes our entire standard of living: exorbitant privilege. It sounds dramatic, almost arrogant, but it's simply the advantage the United States has because the dollar is the world's primary reserve currency. Here's what that actually means in everyday terms. When other countries trade oil, electronics, machinery, or food across borders, they overwhelmingly use U.S. dollars to settle those transactions. Central banks around the world hold dollars in their reserves. International contracts are priced in dollars. Global debt is issued in dollars. And because of that demand, America gets to do something no other country can do. At this scale, we can spend more than we produce for decades and still borrow cheaply. Think about this. For over 40 years, the United States has run consistent trade deficits. We import far more goods than we export. We buy cars from Japan, electronics from China, energy products from abroad, clothing from Southeast Asia, yet we don't have to ship back equivalent goods in return. We ship dollars, and the rest of the world accepts them, often reinvesting them back into U.S. Treasury bonds. That demand keeps interest rates lower than they otherwise would be. It allows the federal government to finance trillion-dollar deficits. It helps support a consumer-driven economy where Americans can access inexpensive imports and relatively cheap credit. In a very real way, the dollar's reserve status has subsidized the American lifestyle. But here's the part most people miss. This privilege isn't a law of nature. It's not guaranteed. It rests on trust. Trust in U.S. institutions, trust in the rule of law, trust in deep and liquid financial markets, trust in political stability. If that trust erodes, even gradually, the privilege weakens. And that doesn't mean instant collapse. It means something slower, but more subtle. Higher borrowing costs, more volatile markets, rising import prices, and a gradual shift in global financial power. The small lesson here is this: we've been living on structural advantages many Americans don't even know exist. And advantages only last as long as the system supporting them remains strong. So the real question isn't whether the dollar disappears tomorrow, it's whether the rest of the world is beginning to quietly diversify away from it step by step. If you spend any time online, you've probably seen dramatic headlines. The dollar is finished. The world is abandoning the U.S. China is replacing America. It makes for great clicks. But is it true? The honest answer is more nuanced and more interesting. Yes, the share of global foreign exchange reserves held in U.S. dollars has declined over the past 2 decades. Around the early 2000s, roughly 70% of global reserves were held in dollars. Today, it's closer to the high 50% range. That's a real shift. But here's what often gets left out. The Chinese yuan accounts for only a small single-digit percentage of global reserves. The euro is significant, but still far behind the dollar, and most global trade, especially commodities like oil, is still priced in dollars. So what's happening isn't a dramatic overnight abandonment. It's something slower, more careful, more strategic. Countries are diversifying. After the Russia sanctions and the freezing of central bank reserves, many governments quietly asked themselves the question: should we hold 70% of our reserves in one country's currency? Not because they hate America, but because concentration risk is real. So they've been adding more gold, expanding trade in local currencies, building backup payment systems, testing alternatives. Think of it less like a rebellion and more like portfolio management. And here's the key insight for Americans: de-dollarization doesn't have to mean collapse to matter. Even a gradual reduction in global dollar demand can mean higher long-term interest rates in the U.S. It can mean less automatic financing of deficits. It can mean a slower erosion of the exorbitant privilege we talked about earlier. The small lesson here is this: change in global finance rarely happens with a bang. It happens quietly, incrementally, until one day the world looks very different. So instead of asking, is the dollar dead? The better question is the world slowly hedging its bets And to understand why that question is even being asked, we need to look at a turning point that shook confidence in the neutrality of the dollar system the moment sanctions became a financial weapon. For decades, the US dollar wasn't just a currency, it was infrastructure. It was the plumbing of the global financial system, the pipes through which trade payments and reserves flowed. Most countries assumed that as long as they played by basic international rules, their dollar assets were safe. Then came 2022, when the United States and its allies froze hundreds of billions of dollars in Russian central bank reserves. It wasn't just another sanction, it was a signal. For the first time in modern history, a major country's sovereign reserves money sitting inside the global financial system were effectively immobilized. Whether one supports or opposes the policy is a separate debate. What matters here is the financial message it sent. Central banks around the world watched closely because those reserves weren't sitting in Moscow. They were held in Western institutions in dollars and euros under the assumption that sovereign reserves were politically untouchable, and suddenly they weren't. That changed the psychological landscape. If you're a finance minister in Asia, the Middle East, or Latin America, you may not be aligned with Russia, but you might quietly ask, if geopolitical tensions rise in my region someday, could my reserves be at risk too? That question alone is powerful. Since 2022, global central bank gold purchases have surged to some of the highest levels in decades. Countries have accelerated discussions about alternative payment systems. Some have increased trade in local currencies. Again, this is not about a dramatic abandonment of the dollar. It's about risk management. The dollar remains dominant. U.S. markets are still the deepest and most liquid in the world, but something subtle shifted. The dollar stopped looking completely neutral, and neutrality is one of the hidden pillars of reserve currency status. Here's a small lesson. Financial power and geopolitical power are now inseparable. When a currency becomes a tool of statecraft, it may also become a variable in global risk calculations. That doesn't mean the dollar collapses tomorrow, but it does mean other nations are thinking more carefully about how much exposure they want to hold. And once you start thinking about exposure, you inevitably start thinking about alternatives, which brings us to the uncomfortable question closer to home. While the world is reassessing the dollar's political risk, how solid is America's own fiscal foundation underneath it? When you hear that the United States has nearly $39 trillion in national debt, the number feels almost abstract. It's so large that it stops meaning anything. Trillions become background noise. But let's slow down and make it personal. If you divide that number by the U.S. population, it represents well over $100, 000 per citizen. That's not a bill anyone is sending you tomorrow. But it reflects obligations accumulated over decades, wars, stimulus programs, tax cuts, social spending, and emergency responses. And here's where it gets even more interesting. That $39 trillion figure only represents outstanding Treasury debt bonds the government has already issued. It does not include long-term commitments like Social Security, Medicare, federal pensions, and other promised benefits. Those are often called unfunded liabilities. They are promises for future payments that do not currently have matching assets set aside to cover them in full. Now, it's important to be clear, the United States is not a household. The federal government can tax. It can borrow. It issues debt in its own currency. That gives it flexibility most countries and certainly most families do not have. But flexibility is not immunity. As interest rates rise, the cost of servicing that debt rises with them. In recent years, interest payments on the national debt have grown so quickly that they are approaching or exceeding major categories like defense spending. Think about that. We are paying interest on past spending at levels comparable to some of our largest current priorities. Here's the small lesson. Debt doesn't destroy an economy overnight, but it narrows options over time. It makes every crisis more expensive. It limits policy flexibility, and it increases dependence on continued global demand for U.S. Treasury bonds. Which brings us back to the bigger picture. If the world slowly reduces its appetite for dollars and U.S. debt, Even modestly borrowing costs here at home could rise further, and that would feed directly into mortgages, business loans, and federal budgets. So the real question becomes, if the U.S. debt trajectory continues, and if global demand for dollars evolves, what happens next? Does another country step forward? Does the system fragment? Or does something else entirely reshape the landscape? To explore that, we have to look closely at the country most often mentioned as the alternative, China. Whenever the conversation turns to the future of the dollar, one name inevitably comes up: China. It's easy to frame the question in dramatic terms. Will the yuan replace the dollar? But the real issue isn't replacement. It's positioning. China is the world's largest manufacturing base. It is the top trading partner for dozens of countries. From Africa to Southeast Asia to Latin America, Chinese infrastructure investment and commodity trade have expanded significantly over the past 2 decades. That creates leverage. China has already taken steps to internationalize the yuan. It has signed bilateral currency swap agreements with multiple countries. It has encouraged energy trades, particularly oil, to be settled in yuan. And it has built its own cross-border payment system, SIPS, as a partial alternative to SWIFT. At the same time, China has steadily increased its gold holdings, and its central bank has been a consistent buyer in recent years. On the surface, this looks like a clear strategy to challenge dollar dominance. But here's the part that complicates the story. The yuan is not fully convertible. China maintains capital controls. Foreign investors do not have the same level of legal transparency and protection that they enjoy in U.S. markets. And perhaps most importantly, China does not yet offer a bond market as deep and liquid as the U.S. Treasury market. Reserve currency status isn't just about trade volume. It requires trust, openness, legal predictability, and massive financial infrastructure. So the more realistic scenario is not that the yuan takes over tomorrow. It's that China gradually increases its influence, especially in trade, across the global south, while the dollar remains dominant but faces more competition. Here's the small lesson. A reserve currency isn't chosen by decree. It evolves from economic structure, trust, and network effects. And those networks take decades to build. The world doesn't need the yuan to fully replace the dollar for the dollar's position to weaken at the margins. Even incremental shifts in trade, settlement, and reserves can matter over time, which leads us to the bigger and more uncomfortable question. If the dollar's dominance slowly erodes, even partially, what would that actually mean for the American economy and the average household? It's a question that tends to trigger strong reactions. Some people laugh it off immediately. Others stockpile canned goods and gold. But let's step back and ask the question calmly. Could the U.S. dollar actually collapse? If by collapse we mean an overnight event where the dollar suddenly becomes worthless, that's highly unlikely. The United States still has the world's deepest capital markets, the largest economy, unmatched military capacity, and strong institutional infrastructure. Those pillars don't vanish in a week, but collapse doesn't have to mean zero. History shows that reserve currencies rarely disappear in a dramatic explosion. They erode slowly, then suddenly. In the early 20th century, the British pound was the dominant global currency. It didn't vanish overnight. Its influence declined over decades as Britain's economic and geopolitical power faded. The transition to the dollar was gradual until it wasn't. So what could dollar collapse realistically look like? It could mean sustained higher inflation. It could mean rising long-term interest rates as foreign buyers demand higher returns. It could mean a weaker dollar internationally, leading to more expensive imports at home. It could mean financial volatility as global portfolios rebalance. Imagine a scenario where major holders of U.S. Treasuries, say Japan or China, reduce their purchases significantly. That alone doesn't crash the system, but it raises yields. Higher yields raise government interest costs. That increases deficits, which may pressure the Federal Reserve to step in. And if the Fed steps in aggressively, printing more to stabilize markets, that can feed inflation expectations, notice how none of this requires a dramatic announcement. It's a feedback loop. Here's a small lesson. Systemic risk rarely looks dramatic at first. It looks manageable until multiple pressures compound. The dollar's dominance gives America enormous resilience, but resilience isn't invincibility. It depends on continued global confidence and disciplined policy at home. And that brings us to another important angle in this story. If the dollar faces gradual pressure, where do investors turn? Gold, Bitcoin, something new. That's where the debate gets even more interesting. Whenever people start questioning the dollar, the conversation quickly turns to alternatives. And usually three names come up: gold, Bitcoin, and more recently, tokenized gold. Let's unpack this calmly, without ideology. Gold has been a store of value for thousands of years. Central banks still hold it. In fact, in recent years, central bank gold purchases have reached some of the highest levels in decades. Why? Because gold carries no counterparty risk. It isn't someone else's liability. It doesn't depend on a government's fiscal discipline. It simply exists. Bitcoin, on the other hand, was created as a decentralized digital alternative to traditional currencies. Its appeal lies in its independence from governments and central banks. It operates on a blockchain, cannot be printed at will, and moves across borders quickly. For many people, that's powerful. But Bitcoin is also extremely volatile. It has experienced drawdowns of 50%, 60%, even 80% multiple times. That volatility makes it difficult to function as a stable store of value in the short term. Then there's tokenized gold, a hybrid concept. Physical gold stored in a vault but represented digitally on a blockchain. This allows faster transfers while maintaining a tangible asset backing. It's an attempt to merge ancient trust with modern technology. Each of these reflects a different philosophy. Gold says trust history, Bitcoin says trust code. Tokenized gold says combine both. Here's the small lesson. When uncertainty rises, people don't necessarily abandon the dollar. They diversify. Some hold a portion of gold as insurance. Some experiment with digital assets. Some buy foreign stocks or real assets. The key is not picking a side in a cultural war. It's managing risk intelligently, and that leads to a deeper question. If the dollar's role evolves and alternatives gain traction, what does that mean for the American standard of living itself? Because ultimately, currencies are not just financial instruments, they shape everyday life. You've probably heard the phrase before, maybe in a heated debate, maybe from a market commentator, the U.S. is just a giant Ponzi scheme. It's a powerful accusation. But let's slow down and examine what that actually means. A Ponzi scheme works like this. Early investors are paid with money from new investors. There's no underlying productive engine. The system depends entirely on a continuous inflow of new money. When that inflow stops, it collapses. Now, here's why some critics draw the comparison. The U.S. government continuously rolls over its debt. Old bonds mature and new bonds are issued to pay them off. Deficits are financed by borrowing more. Interest payments are covered by issuing additional debt or by expanding the money supply. On the surface, that dynamic can look similar. But here's the crucial difference. The United States has a real productive economy behind its debt. It has taxation authority. It has assets, infrastructure, businesses, land, intellectual property, and a highly developed capital market. It also issues debt in its own currency. That doesn't make the debt harmless, but it makes the system fundamentally different from a fraud scheme. Still, the analogy resonates for a reason. If deficits keep expanding, if political leaders refuse to address long-term liabilities, and if debt grows faster than economic output for too long, the system becomes increasingly dependent on continuous borrowing at manageable interest rates. And that dependence can feel fragile. The small lesson here is this. It's easy to use dramatic language. It's harder, but more useful, to understand structural risk. America is not a Ponzi scheme, but it is running a fiscal path that relies heavily on continued confidence, continued demand for Treasuries, and the continued belief that the system will remain stable, and if that confidence ever wavers, not collapses, but simply weakens, the consequences would ripple directly into everyday American life. Which brings us to the final and most personal question of all. What would it actually mean for American households if the dollar's dominance slowly fades? Up until now, we've been talking about currencies, reserves, central banks, and global trade. Big concepts, abstract ideas. But let's bring this home. What would it actually mean for everyday Americans if the dollar's reserve status slowly weakened? It wouldn't look like a Hollywood disaster scene. It would look much more familiar, just amplified. Start with prices. The United States imports a huge share of the goods Americans use every day: electronics, clothing, appliances, industrial components, even basic household items. If the dollar weakens significantly, those imports become more expensive. That translates directly into higher consumer prices. We got a small preview of how sensitive Americans are to price increases during the inflation surge of 2021, 2022. Gas prices, groceries, rent, even modest increases created real strain. Now imagine a scenario where imported goods are structurally more expensive for years, not months. Next, think about interest rates. The dollar's reserve status helps keep demand for U.S. Treasury bonds strong. If foreign demand declines meaningfully, the U.S. may need to offer higher yields to attract buyers. Higher Treasury yields feed into mortgage rates, car loans, business borrowing costs. That means more expensive homes, more expensive credit cards, more expensive small business loans. Then there's asset prices. For decades, strong global demand for U.S. financial assets has supported high valuations in stocks and real estate. If capital flows become more diversified globally, U.S. asset prices may not enjoy the same automatic tailwind. None of this guarantees collapse, but it does suggest adjustment. The small lesson here is this: the dollar's global role quietly supports American purchasing power and borrowing costs. If that role evolves, American lifestyles may need to evolve with it. That doesn't mean decline. It could mean rebalancing, more domestic production, more savings, less consumption driven by debt. History shows that economic transitions are rarely comfortable, but they are survivable when managed wisely. And that brings us to the final question. If the world is gradually shifting and the dollar's position may not be permanent, what should individuals actually do in response? How do you prepare, not out of fear, but out of prudence? That's where we conclude. After all of this reserve currency dynamics, debt levels, de-dollarization, gold, China, the natural question is simple. Okay, so what do I actually do? It's easy to get pulled into extreme narratives. Sell everything, buy only gold, abandon U.S. assets, bet the farm on Bitcoin. But history teaches us something important. The people who survive long transitions aren't the ones who panic. They're the ones who prepare thoughtfully. First, understand this: the U.S. economy is not disappearing. It remains one of the most innovative, productive, and resilient systems in the world. American companies lead in technology, medicine, aerospace, energy, and finance. That foundation still matters, but concentration risk matters too. If the dollar's dominance slowly erodes, not collapses, but softens, then diversification becomes more important than ever. That could mean some exposure to international equities, especially in countries with stronger fiscal positions or rising productivity. A measured allocation to real assets, energy, commodities, infrastructure, a modest allocation to gold as insurance, not as a bet against America, but as protection against policy uncertainty. Reducing excessive leverage, because in a world of potentially higher rates, debt becomes more dangerous. Notice what's not on that list: extremes. You don't have to abandon ship. You don't have to bet on collapse. But you also don't have to assume the next 30 years will look like the last 30. Think about how previous generations adapted. In the 1970s, inflation forced investors to rethink portfolios. After 2008, low rates changed asset allocation strategies. After 2020, supply chains and geopolitical risks reshaped global thinking. Transitions happen. The smart response is flexibility. Here's the small lesson. Investing is not about predicting the end of the world. It's about building resilience for multiple possible futures. And that's really the heart of this entire conversation. Most Americans don't wake up thinking about reserve currency status or global capital flows, but they are living on a system that has quietly given them extraordinary advantages. Those advantages may evolve, they may adjust, they may face pressure, but awareness is not fear, it's empowerment. The goal isn't to panic. It's to understand the foundation you're standing on and make sure your financial life is strong enough to stand on its own, even if that foundation shifts. And that, more than anything, is what Americans don't always realize they've been living on.